Today is Saturday, June 25, 2022. Let us take a look at today's crypto headlines. How low can Ethereum price drop versus Bitcoin amid the DeFi contagion? Small-time investors achieve the 1 BTC dream as Bitcoin holds $20,000 range. What are Bitcoin covenants, and how do they work? BTC price tops 10-day highs as Bitcoin whale demand sees huge spike. Please like, subscribe and turn on the notification button to keep supporting our channel. How low can Ethereum price drop versus Bitcoin amid the DeFi contagion? Interestingly, Ethereum has not reclaimed its all-time high against Bitcoin since June 2017 despite the NFT craze. ETH-BTC dynamics. The ETH-BTC pair's bullish trends typically suggest an increasing risk appetite among crypto traders, where speculation is more focused on Ether's future valuations versus keeping their capital long-term in BTC. Conversely, a bearish ETH-BTC cycle is typically accompanied by a plunge in altcoins and Ethereum's decline in market share. As a result, traders seek safety in BTC, showcasing their risk-off sentiment within the crypto industry. Ethereum TVL wipeout. Interest in the Ethereum blockchain soared during the pandemic as developers started turning to it to create a wave of so-called decentralized finance projects, including peer-to-peer exchange and lending platforms. That resulted in a boom in the total value locked, TVL, inside the Ethereum blockchain ecosystem, rising from $465 million in March 2020 to as high as $159 billion in November 2021, up more than 34,000%, according to data from DeFi Llama. Interestingly, ETH-BTC surged 345% to 0.08, a 2021 peak, in the same period, given an increase in demand for transactions on the Ethereum blockchain. However, the pair has since dropped over 35% and was trading for 0.057 BTC on June 26. ETH-BTC's drop coincides with a massive plunge in Ethereum TVL, from $159 billion in November 2021 to $48.81 billion in June 2022, led by a contagion fears in the DeFi industry. Also, institutions have withdrawn $458 million this year from Ethereum-based investment funds as of June 17, suggesting that interest in Ethereum's DeFi boom has been waning. Bitcoin struggling but stronger than Ether. Bitcoin has faced smaller downsides compared to Ether in the ongoing bear market. BTC's price has dropped nearly 70% to around $21,500 since November 2021, versus Ether's 75% drop in the same period. Also, unlike Ethereum, Bitcoin-focused investment funds have seen inflows of $480 million year-to-date, showing that BTC's drop has done little to curb its demand among institutional investors. ETH-BTC downside targets. Capital flows, coupled with an increasing distrust in the DeFi sector, could keep benefiting Bitcoin over Ethereum in 2022, resulting in more downside for ETH-BTC. From a technical perspective, the pair has been holding above a support confluence defined by a rising trendline, a Fibonacci retracement level at 0.048 BTC, and its 200-week exponential moving average, 200-week EMA. The blue wave in the chart below, near 0.049 BTC. In a rebound, ETH-BTC could test the 0.5 fib line next near 0.062. Conversely, a decisive break below the support confluence could mean a decline toward the 0.786 fib line at 0.027 in 2022, down more than 50% from today's price. The ETH-BTC breakdown might coincide with an extended ETH-USD market decline, primarily due to the Federal Reserve's quantitative tightening that has recently pressured crypto prices lower against the US dollar. Conversely, weaker economic data could prompt the Fed to cool down on its tightening spree. This could limit Ether and the other crypto assets' downside bias in the dollar market, per Informa Global Markets. Macroeconomic conditions need to improve and the Fed's aggressive approach to monetary policy has to subside before crypto markets see a bottom. But given Ethereum has never reclaimed its all-time high against Bitcoin since June 2017 despite a strong adoption rate, the ETH-BTC pair could remain under pressure with a 0.027 target in sight. Small-time investors achieve the 1 BTC dream as Bitcoin holds $20,000 range. With BTC recently trading at the $20,000 range for the first time since 2020, small-time investors found a small window of opportunity to achieve their dream of owning at least one Bitcoin. Ever since early Bitcoin, BTC investors woke up millionaires as the ecosystem gained tremendous popularity alongside the mainstreaming of the internet. Investors across the globe have been in the rush to accumulate as many of the 21 million BTC. One Satoshi at a time. With BTC recently trading at the $20,000 range for the first time since 2020, small-time investors found a small window of opportunity to achieve their dream of owning at least one BTC. On June 20th, the number of Bitcoin wallet addresses containing 1 BTC or more increased by 13,091 in just 7 days. While the total number of addresses holding 1 BTC saw an immediate reduction in days to come, the crypto community on Reddit continues to welcome new crypto investors that hodled their way into becoming a wholecoiner. Redditor Arbalist_22, who shared the above screenshot, revealed that it took him around $35,000 in total to accumulate 1 BTC over several months since February 14, 2021. Showing further support for the Bitcoin ecosystem, the Redditor aims to continue procuring Satoshis or Sats until he accumulates over 2 BTC. Arbalist_22 started purchasing BTC from crypto exchange Coinbase but later started using Strike owing to lower fees. Sharing a peek into his future plans, they stated, "I'm hoping in the future I can treat it more like rich people treat real estate and take loans out against it. Then as it appreciates just pay off the old loan with a new one. Boom. Tax-free income." Following suit, another Reddit user Evening Main 58602 posted about being able to 1 BTC after largely following a dollar cost averaging DCA strategy, wherein they regularly bought smaller amounts of BTC over a long period of time, stating, "I was able to catch the falling knife and buy enough to get me over the finish line. This was no easy feat. I'm just an ordinary guy with an ordinary life." Between June 15th to June 25th, the total number of Bitcoin wallet addresses holding more than 1 BTC grew by 873, according to Glassnode data. While falling BTC prices are seen by many as an investment opportunity, Google search trends highlight the tendency of other investors to speculate about its demise. The Google search results reflect peak anxiety for the cryptocurrency markets following weeks of relentless sell-offs in asset prices. What are Bitcoin covenants, and how do they work? 1. What are covenants? A covenant is used in private property law as a contract to restrict an object's use, for example, the interdiction to extend a building or change a facade's color. Since Bitcoin is private property, the term covenant seems perfectly fitted to indicate restrictions on its transactions. You have ownership of the property but can be limited in what you can do with it. Specifically, Bitcoin covenant proposals restrict how a coin can be spent after you bought it and where coins can be transferred. These restrictions can be compared to those that banks might place on specific merchants suspected of engaging in illicit activities. Covenants can be useful to upgrade Bitcoin. However, since they are complex to implement and trigger controversy over the cryptocurrency's fungibility and censorship-resistant property, they have not been seriously considered for inclusion in Bitcoin for a long time. 2. Can Bitcoin be improved? Bitcoin can undoubtedly be improved, and BIPs, including covenants, represent proposed changes to Bitcoin's consensus. Covenants are included in Bitcoin improvement proposals, BIPs, the upgrade and improvement process Bitcoin undergoes to modify and advance issues like scalability, security and usability. Covenants allow a Bitcoin script language to prevent an authorized spender from spending on specific other scripts. They describe how to improve Bitcoin in smart contracts, information included in a code that executes when certain conditions are met. These Bitcoin contracts could prevent users' funds from being stolen in case of hacking and can also help scale the network. There are many proposed applications for covenants, from scaling Bitcoin transaction capacity to congestion control, trust-minimized loans and more. These use cases are described in the controversial BIP 119, presented by developer Jeremy Rubin as a soft fork, and discussed by the community. This Bitcoin improvement proposal introduces a change to Bitcoin's code, which seeks to use a new operation code, opcode. The opcode is op_CHECKTEMPLATEVERIFY. CTV-style covenant, and enables a limited set of precious use cases without incurring significant risks. CTV can potentially help scale Bitcoin through the implementation of congestion-controlled transactions. When transaction traffic is very high, fees increase exponentially. Using this CTV, large payment processors can include all their payments in a single transaction for confirmation purposes, saving block space and resulting in faster and cheaper execution. 3. How do Bitcoin covenants work? Covenants can be defined as linguistic primitives, the smallest and simplest unit of processing available to a programmer, that extend the Bitcoin script language, allowing transactions to restrain the scripts of the redeeming ones. In a typical Bitcoin transaction, your Bitcoin is protected with a locking script, whose conditions should be met if you want to spend the coins. Examples of locking conditions can be the denial of expenditure without a signature proving you have the private key that matches the public key, or time locks, which are similar to covenants and indicate that coins can't be spent until after a certain number of blocks. So whereas in a normal Bitcoin script, we only require specific conditions to be met to unlock a particular requirement, sign a transaction with a private key, for example, in a covenant, we go a step further by restricting what you can do with that coin, or where a coin can be spent. A Bitcoin covenant is often defined as a mechanism to enforce conditions on how the control of coins will be transferred in the future, and includes a set of conditions on an unspent transaction, TX, output, UTXO, which defines how the transaction's relevant coins can be spent. For example, one wallet can place a covenant on the Bitcoin it holds whitelisting a few related addresses. When this wallet broadcasts a Bitcoin transaction to another wallet, in turn, this wallet can only send the same Bitcoin to addresses included on that whitelist. 4. Advantages of Bitcoin covenants. Improving Bitcoin security is one of the most significant advances constantly sought by developers, and covenants might offer a great helping hand in enhancing it. Besides improved scalability, covenants are helpful for security, especially against some form of the $5 wrench attack. Taking steps to protect your Bitcoin property so that it becomes harder for people to steal is an excellent use case. Another good security approach provided by covenants would be to restrict your UTXO to be sent to a multi-sig address after a year, for example. Covenants can also address the difficulty of secure key management, and implementing secure vaults can help with one of the biggest problems of cryptocurrency security. Vaults enhance end-user security by disincentivizing the theft of coins. The user employs a mechanism that prevents an attacker from gaining full control over funds despite stealing the private keys used to secure them. This mechanism includes the use of pre-signed transactions with key deletion to enforce a time lock on funds. Covenants can also implement a restrictive mechanism to prevent double spending attacks in Bitcoin Inc., a Byzantine fault-tolerant blockchain protocol that has been recently proposed to improve Bitcoin's throughput, latency and overall scalability. This mechanism is translated into so-called poison transactions that can be implemented progressively as an overlay on top of the Bitcoin blockchain. 5. Drawbacks of Bitcoin covenants. Various prominent Bitcoin experts, including Adam Back, Jimmy Song and Andreas Antonopoulos, have raised some concerns over the implementation of restrictive covenants, in particular with the BIP 119. In particular, Antonopoulos has voiced concerns over recursive covenants that the new update could convey, thereby deteriorating the network. A recursive covenant occurs when a programmer restricts a transaction, but he does it in a way that restricts another transaction after that, starting a domino effect resulting in future limitless recursive covenants. Blacklisting and risks of censorship and confiscation. While locking up where a Bitcoin can be spent is advantageous to ensure more security, it also provides grounds for censorship and control by governments, which would hinder the very existence of Bitcoin. Authorities could potentially force exchanges to withdraw only to covenants with some control over the coin. While this same risk already exists, since governments can ask exchanges to send only to addresses with a taproot spend path or multi-sig controlled by them, could the implementation of covenants facilitate malicious purposes where it would make it easier for governments to enforce a sort of on-chain KYC? Fungibility threats. Covenants might interfere with Bitcoin's fungibility, the ability of each Bitcoin to be identical in function and quality. While useful for security and scalability, covenants would change the properties of specific Bitcoin units, essentially creating different types of digital currency, distinct according to what could be spent or where it could be sent. As a result, those who oppose the change argued that limiting how you can spend your Bitcoin would ultimately limit Bitcoin's use as a digital currency, with inevitable consequences in its value. There are strong opinions on covenants' pros and cons. However, debates are healthy and necessary to improve a decentralized and leaderless network. Ultimately, the final decision will be down to the users and node operators who will download the software that better reflects their viewpoint. BTC price tops 10-day highs as Bitcoin whale demand sees huge spike. Dip buying appears to be in full swing among whales, new data shows, but analysts remain wary on the outlook for the short term. Bitcoin, BTC, made the most of weekend volatility on June 26 as a squeeze. Saw BTC USD reach its highest in over a week. Unusual whale activity, flagged. Data from Cointelegraph Markets Pro and TradingView followed the largest cryptocurrency as it hit $21,868 on Bitstamp. Just hours from the weekly close, a reversal then set in under $21,500, Bitcoin still in line to seal its first green weekly candle since May. The event followed warnings that volatile conditions both up and down could return during low liquidity weekend trading. On-chain data nonetheless fixed what appeared to be buying by Bitcoin's largest volume investor cohort prior to the uptick. Unusual whale activity detected in Bitcoin, popular analytics resource game of trades observed. The supply held by entities with balance. 1K10K BTC just saw a huge spike in demand. Let's watch if the trend confirms. An accompanying chart from on-chain analytics firm Glassnode showed shifting up markedly from around the time. BTC USD hit lows of $17,600 this month. As Cointelegraph reported, whales had eagerly purchased BTC below $20,000, forming new support clusters in the process. CME futures gap looms large. For others, however, conservative views on price action remained the norm. Cointelegraph contributor Michael van de Poppe eyed the need to crack $21,600 definitively in order to secure the chances of further upside. Additionally, last week's closing price of $21,100 on CME Group's Bitcoin futures could provide a short-term target. Standard weekend fake-outs happening and probably ending at CME close at $21,100 for Bitcoin, he forecast on the day. No clear breakout above $21,600 at this point, yet. The monthly close was still on course to cement Bitcoin's worst June on record with monthly losses of almost 33%. Along with May 2021, this would also be the worst performing month since before the 2018 bear market bottom, data from on-chain monitoring resource CoinGlass confirms. Don't forget to like, subscribe and turn on the notification button so that you won't miss any